Good afternoon, everybody, and welcome to this week's edition of the Elite Traders Club education session. It's Wednesday, 2nd of March 2016. Let's get underway with our disclaimer. The content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So, before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances or seek further advice on its appropriateness. All right, the agenda for today. What I'd like to talk about is really matching your trading or investing style to your personality. And I think that's a very important and often underrated aspect of people's awareness or experience in the markets. Really, at the end of the day, you need to find yourself a system or a methodology that is a good fit in terms of your personality. A lot of people, unfortunately, follow systems that don't fit in with their own personality, and they find they're going very tough indeed. So certainly making sure that you're comfortable and understanding of your particular strategy, your own strengths and weaknesses, and how that might impact on your trading, I think is very important. Trade management, we're going to spend a fair bit of time talking about different ways to manage your trades. Obviously, trailing stops is the preferred method of trade management, so we'll go through and have a look at some lots of examples of that. Typically, our trade management involves either an ATR trailing stop or potentially a longer-term moving average, which I'll discuss today as well, and also the prudent use of price volume volatility signals. It's one of the aspects of longer-term trading or investing, building a super fund, that sort of thing. Or even sort of intermediate sort of time frames, is the fact that sometimes you can end up quite a way up in a trade only to see the market turn around due to excessive volatility and take a lot of those profits away. So I think it certainly makes sense to take some partial profits along the way, keeping in mind that the safest place for your capital is actually out of the market. Whilst it's in the market, then it is subject to market risk, and we don't know what sort of things are going to be thrown up from time to time. So certainly taking advantage of those signals, I think, makes very good sense. So that's what we'll be going through today. So first cab off the rank, passive or active investing. Is there really much of a difference between the two? I guess the way I look at this is that passive is perhaps I'm thinking more longer term, and I'm typically thinking of the client who really is very, very busy. It doesn't have a lot of time to manage their portfolios. There's a lot of statistics about that show that a lot of people are spending up to 3 hours a week managing their self-managed super fund, which is a huge amount of time, and it really shouldn't be like that. Typically, most investors who haven't had sort of any degree of education about the markets have typically been long-term buy and hold or buy and forget, and clients who've generally liked getting dividends along the way. So the way I think about the more passive investor or passive trader, again, using that word trader, just investing with a plan. It really doesn't matter what your time frame is. So I'm thinking, people who are looking further out, longer term, rather than sort of 3 months to 6 months, are really thinking 6 months to 12 months as a minimum. Like to collect dividends along the way, and for them, entry is not quite as important as it might be for somebody who is a little bit more active. So typically the active investor, doing scans on a fairly regular basis, really focusing on the timing for their particular entry. So really trying to nail that. And for them, movement in the stock is really important, whereas the passive investor, not too concerned if a stock goes sideways for a period of time, because their outlook is for further into the future, and they're hoping to get some dividends along the way. What is important to both of these styles, if you like, or personalities, if you want to call it that, is the aspect of relative strength, and that's a key driver for both. So whether you're a longer term, slightly less active investor, or somebody who is active, relative strength is really very, very important, because relative strength tells us where the money is going, if you like, flowing into stocks, and on that basis showing us over a period of time that it's outperforming the broader market in short, medium and longer term time frames. Now, the other side of the coin there is we don't know how long that relative strength is going to continue for. However, there's been many studies that illustrate quite strongly that once that relative strength starts to appear in the market, that can actually go on for quite a considerable period of time. So the great unknown in the markets is, how long is it going to go for, and how far is it going to carry your stock for? Is it going to carry it just to the next little peak and only to fall away? Who knows? And that's where the aspect of managing your risk is really important, and having a clearly defined exit strategy that you can follow very, very comfortably. So trade management, we've discussed as part of Elite Traders Club for quite a period of time now, the use of a trailing stop. I've spent a lot of time on this, going back over various levels of ATR trailing stops, whether you use a 2, a 3 or a 4. And it really, came home to roost that using a 3 or a 4 ATR, having a wider stop was much preferred. The only aspect that you need to consider is that once you start using the wider stop, is that you can give more back. So for somebody who's particularly a little bit more active, these are a very efficient tool to trail your positions with, because they do help you to retain a significant amount of your profits along the way. And certainly when used with prudent use of price volume volatility signals, it can be a very effective method for trade management. The 63 EMA, and we'll go through and we'll have a look at some charts in a moment, is very effective, I think, more for your passive, longer term style of investor stroke trader. And the reason for that is that it does allow big swings in price over an extended period of time. And from that point of view, it's quite handy in terms of managing your trade, but whilst at the same time helping you to collect dividends along the way. And certainly the 63 period moving average, it doesn't move a lot. Price can sometimes move a long way away from the 63 period moving average, and if you're not too concerned about the ebbs and flows in the market, it is a very simple version of trade management. The important aspect of it, doesn't matter which of these methods you use, is your exit, and you must exit once price closes below your trailing stop, whether that's a 3 ATR, whether it's a 63 period moving average, or whether it's some other indicator that you use. You've got to have a clear-cut signals that tell you, extremely clearly. Hopefully, it's a lot clearer than my speech at the moment. That once price, gets to a particular level, that you take action and exit the trade. So what we might do is go through and have a little bit of a look at a few charts along the way. And what I'll do is I'll just bring up a list of stocks. Now, these are stocks that I've selected that have been in the Elite Traders Club watch lists over the last few years, just to exhibit the relative merits of either using a 3 ATR trailing stop or the wider 63 period moving average trailing stop. So on these charts, these analyses that I've done, I've got the initial date of entry. So this is a stock, TNE Technology One. You'll see there way back in March of 2012. Now, typically, the method that we've been following is that once price closes below its trailing 3 ATR, so initially when we're doing our trade setup, we might start off with a protective stop that's at least 2 ATRs away, maintain that protective stop and wait for the 3 ATR to come up and pass it, and that therefore then becomes the default trailing stop. So in this particular stock, Technology One, this was one that was in the portfolio long before I took over the management of the watch list, etc., a number of years ago. And if at that time we had been using the trailing 3 ATR stop loss, you'll see the little circle here, we would have been stopped out. So for perhaps a small loss on that particular example. However, using the 63 period moving average, which is this blue line, you'd see that we've been in that trade all the way through from 2012, an entry level just approximately, if I just put on a horizontal line there just to give us a bit of an indication where that was, at around about $1, let's call it $1.15 as an example. So since that point, price hasn't actually closed below that 63 period moving average. So it's worked very, very effectively. And you can see a number of times where, price moves along and then, it retraces again. And a number of opportunities, through here where your trailing stop would have been very close to being triggered again had you taken any subsequent orders along the way. But your initial 63 period moving average has done a fantastic job of keeping you in the trade. Price did come down and touch those levels previously, sort of in the middle of 2015 rather, before rebounding quite strongly. The other element of that is that you've picked up these dividends along the way. So it certainly does make it a very passive style of trade management. EVT, this is a stock that's just recently changed its stock code. I think it was AHD. Way back in the 1st of June 2012. Again, another entry, and again, typical setups, relative strength, etc. And again, you've got your green trailing 3 ATR, which happened to be stopped out around about 12 months later on. However, your 63 period moving average, you'll see, still has us in the position. So the difference between those two, just very, very simply, in terms of where we exited, getting out at $7.60 roughly, or still being in the stock at twice that price, and again, picking up some dividends along the way. And it's no simpler than just following the little blue line, which is the 63 period moving average. Now, obviously, if you happen to use the 3 ATR, that's fine because you've got your exit points along the way. You've made a bit of profit out of this particular trade, and there's a number of opportunities to get back in. And again, by getting back in and not being frightened, that 3 ATR, again, has served pretty well at the same time. So the other element of this that I'll just introduce as well is just the price volume volatility signal. So again, we talked about sometimes when you're quite a significant way up in a trade, the market can certainly create a little bit of havoc, turn around, and all that profit that you may have on a trade can disappear if you're not prudent in terms of watching your trade along the way. So certainly as examples, perhaps getting back into a trade if you're a little bit more active, if you had been stopped out looking for another entry, seeing some of these signals going off. Now, obviously, if you get back in and the signal goes off fairly soon after getting in, you're not going to take any action. But once you start to get up at least 2 to 1 in the trade, banking some of those profits makes a lot of sense. And you'll see that, as price goes up, even on this candle up here, an opportunity to bank some profits if you hadn't at that particular time. Well, a couple of weeks later on, price moves from around $16 all the way back down to close to $13.50. So again, just using those levels to take partial profits along the way can certainly help, particularly more so if you're the active type of investor, as opposed to the longer term dividend collecting style of investor. It's still obviously looking for growth, but the actual timing of aspects, etc., is perhaps not quite as important to you. So CBA was actually in the watch list a number of years ago, and we had a small profit on that particular stock. And a lot of people like the banks, and I don't have any problems with that. They've been good dividend producers over the longer term, and hence they've been attractive to retirees, etc. But there is a time that perhaps suggests when you need to be out of these stocks, and certainly the ways that the banks move, using your trailing 3 ATR probably flicks you in and out of these sorts of stocks a little bit more often than perhaps you might like. So using that wider trailing stop certainly gives it a lot more room to move. And in this particular instance, getting kicked out of the trade back in June of 2013, or being in it still around about 12, 14 months later on, you're picking up 4 dividends along the way, which is a nice little bonus. Plus, you're getting that extra little bit of capital growth at the same time. So, again, depending on your style of trading along the way as to what's more important for you. NIB Holdings, again, this was the entry level back in 2012. Interestingly, the 3ATR actually, when we first got in, was pretty close to the 63 period moving average, and that's actually quite a good thing. If we've got the good relative strength, etc., then your initial risk in terms of where you're putting your protective stop is almost the same for your ATR or your EMA. And you'll see along the way that eventually price closed below the trailing stop in what ended up being quite a significantly profitable trade. Had we stuck with the 63 EMA, well, by the time it closes below, we're actually getting out at very similar prices to the ATR, but at the same time, just collecting perhaps an extra dividend along the way. The important element here with any of these particular trades is that you've got your trigger system for exiting the trade, and you really must follow it all at all times. So G8 Education was certainly another stock that performed really, really well for a significant period of time, and you can see there how well that 3ATR has worked along the way. So the close there on that particular day, 422, and you'll see that our trailing stop there is at 424, so the close there was below. So on that particular occasion, kicking us out of the trade there, I'm not too sure why. I've got that circle over there. I'll put him over there because that's where the trigger point is. But using the 63 period moving average, then we get over to that little doji right there, which closes below the 63 period moving average, and fairly similar levels to where price closed below our ATR. But the other aspect of that again is you're picking up a couple of dividends along the way as well, which probably makes up for that small difference in price there. Supercheap Auto, Super Retail Group, which Supercheap Auto is part of. Again, way back in 2012, moving up very, very strongly. Price did close down below the trailing 3 ATR, and this is certainly a stock here that if we put on our price volume volatility signals, there we go. So some opportunities once prices really move quite significantly, opportunities to take some partial profits along the way, and certainly taking some profits at these levels. And if you did that knowing how significantly up you are in the trade, just makes good sense. Price comes back down and closes below. So you're not giving all that profit away. Okay, so you're keeping a fair amount of that. Alternatively, if you're using that 63 period moving average, price does eventually close below it and a big spike down. And again, exiting at pretty similar levels here to what you were with the use of the 3 ATR stop. And again, main difference being picking up an extra dividend along the way. Interesting, if you go back over a period of time, you'll see times where your 3 ATR and your 63 period moving average are close together. And this is typically a good spot to enter trades, particularly when you're getting periods of consolidation. And I'll just pop this on the chart and just explain that a little bit. So when you get some sideways movement over a period of time, what you might call a period of stagnation, what you're looking for is, as stocks are coming out of a sideways moving pattern, that we're starting to get the formation of higher troughs. And once we break out, that we're establishing, a succession of higher troughs along the way. And if we do have any pullbacks, that the pullbacks are not too significant. And again, we get that really nice motive phase where we're getting higher troughs again along the way. Now, at this particular point in time, once we first break out, you'll see that the ATR moves away from our 63 period, the longer term moving average, and then eventually, again, no sooner as a breakout, and it really starts to go sideways again, and our ATR line catches up with our 63 period moving average before taking off again and moving up quickly. And then naturally, if it starts to move up quickly, that trailing ATR, which is a 21 period ATR, so what it does is it looks back 21 periods and does all its calculations based on that, whereas your 63 looks back 63 periods. So once the stock really starts to move, you'll find that the ATR, the green line, sticks much closer to the price and is really for those people who are looking to take advantage of those, fairly, by comparison, fairly quick moves to the upward side, and perhaps looking to take some profits along the way. So that's the main difference between the two styles, if you like. Really interesting if you go back over lots and lots of charts and have a look, particularly in stocks that have based. So by basing, I mean have really flattened out in their formation, spending a lot of time in stagnation, that sideways movement. And then what you're really looking for is an increase in relative strength, a move out of those particular areas. Now, once you start to move out of those areas, they're often quite good trade setups, because the market spent so much time looking at a stock going sideways, it's actually started to realise that it does offer good value, etc., fundamentally, and we get to see that on a chart. Now, because it's been going sideways, you're going to find that your EMAs are quite flat and that your ATR lines are also pretty flat as well. So those opportunities there in terms of your initial risk, where you're putting your protective stops, you're going to end up having your ATR lines and your 63 period moving averages as protective stops in fairly close proximity to each other. Obviously, as the trade starts to move, and if you were to take breakout trades through any of these levels, you're starting to find that your ATR line is starting to move further away from your longer term moving average. And these sorts of levels up the top here, again, when you're taking really clearly structured trades and really nice price action, but you're finding that your ATR is a long way away from your 63. So if you were to try and enter a trade up here, think about how far away your protective stop is if you are one of those more sort of passive, longer term style of investor stroke traders. So again, I think it pays for you to sit down and think about a little bit about what style of a trading or interaction you like to have in with the markets, and make your decisions on how you like to manage your trades based on that. Interesting here on Crown Resorts, and again you'll see here that there's a long period of sideways type of movement, and as a result you'll see the 63 period moving average really just runs through the middle of that, and it's not until we start to get a little bit of movement along the way, and again you can see here the relative strength holding up pretty well. So obviously during 2011, early parts of 2012, stock going sideways, the rest of our market actually heading down. Once we start to break out of this particular level and we start to see higher troughs along the way, and things progress really nicely. Interesting that at this sort of breakout level that our ATR and the 63 period moving average are actually very close together, and stock moves up really, really nicely. And again, it's the really good example of opportunities to take profit along the way when these price volume volatility signals go off from a more active trader's point of view, collecting dividends along the way. And where did price close and eventually mean that we had to leave the trade? Well, it actually coincided with a close below the trailing 3 ATR and also the 63 period moving average as well. So that would have been a really nice trade, collecting dividends, making some really nice capital upside as well. Interesting to see where that stock's gone from then. So again, it's so important that once you get those signals to leave the trade is to cash in, take your money and look for something else that has been moving in the right direction, and there's been quite a number of stocks in that category over 2014 and 15 despite broad market weakness. So again, just a bit of an overview there. The difference between your 63 and your trailing 3 ATR, your 63 giving it a nice wide berth along the way, and it's a really good style of trade management for those of you who are a little bit too busy with your own lives to to use the 3ATR. Retail Food Group, another example. Again, interesting at the time of these particular setups. And again, it was more a function of the market than anything specific, where we had a lot of stocks that were actually going sideways. And that time will come around again. There's not very many stocks at this stage that have really sort of broken out of sort of sideways moving patterns, where we've had a ceiling established, some floors, and then breakouts and retests, etc. We haven't had a lot of those sorts of setups of late. Now, eventually that will happen again, because those sorts of setups do offer some quite good entries by and large. So here, getting stopped out of a 63, below our 3 ATR. So on that one, they're probably coming out with a little bit above break even on that one, staying in until we get a close below the 63. Well, the advantage there, we pick up a couple of dividends along the way, and we also get a little bit more capital growth on the other side of the ledger as well. Interesting, isn't it, that once you start getting closes below that 63 period moving average, that the market is really starting to push the stock further and further down. Even if you had been, you're in the trade and you took your exit there as you should have, other opportunities to get back in. So again, thinking about the fact that we've got higher troughs breaking out above previous levels, and again choosing whether or not you, a person who is active and therefore wants to make use of price, volume, volatility signals, as an example up here or through here, or whether you're longer term and just want to get out once price closes below, picking up your dividends along the way. Or in fact, you might even choose to do both. Again, you know yourself better than what I do. All right, so I think what we might do now is just pop back and just recap on things. So again, your 3 ATR, very effective if you're more active. 63, very effective if you are longer term in nature, good for collecting dividends along the way, but importantly for both, you must exit once price closes below. Price volume volatility, very effective for locking in partial gain, so consider doing that. It doesn't really matter whether you are longer term in nature or perhaps a little bit more active. The important element of that is that it helps to reduce exposure, because again, the market is extremely volatile. We don't know when we're going to get some of those events that can certainly extract a lot of profit from your positions if they're in the market. So certainly that helps to reduce the chance of giving a significant amount back. And the other side of the ledger as well, if you are taking some partial profits along the way and you see opportunities to get back into that particular trade, and so really what that means, are you seeing some higher troughs forming after you've taken some partial profits? And if there is, and you've got that good relative strength, then certainly look to add back into those positions as well. All right, that's it for this week, folks. Thanks for watching, and I look forward to presenting another education session shortly. Bye for now.